This week we've had three key Australian releases which have really been our focus. Starting off the week we had the wage price index. Following on from last week's quite soft labour force release, the wage price index for Q4 was also quite weak. We saw there was a 0.5% gain for Q4, and that saw annual growth at 2.2%, which is down from 2.5% in Q3. Private sector growth in wages really is kind of where the weakness is, with growth in that sort of subcomponent up 2% for the year and 0.5% in the quarter. And even if you include bonuses, it's still only up 2.2% over the year. So whether it's on base wage or in total compensation measures, you're still seeing quite weak growth in that private sector outcomes. It's important to note that this is a broad trend across the nation. So although there is more weakness in WA, where we're having the sort of the unwind, the mining investment boom, even in New South Wales, which has the lowest unemployment rate and has seen quite strong jobs growth, we're still only seeing wages growth of about 2.1%. So both sort of across the nation, we're seeing this kind of weak trend come and play through. In terms of real wages, that actually means that real wages are effectively flat over the year. And if you look at it more from a headline basis, because we've seen the decline in the oil price, and that's led to a decline in headline inflation, they're up about 0.5% of the year. So on either basis, you're not really seeing a lot of momentum come through for discretionary spending. The second sort of major release this week, two different releases, which we're looking at investment ahead of GDP next week. What we saw with regards to the construction work done release was as expected. It was weak, falling about 4% both in the quarter and over the year. That's really a sign of residential investment and the public sector spending we are seeing being offset or more than offset by the continued weakness in mining investment. This is likely to be a continuing theme as we move through the next couple of quarters and continue to see this drag come through from mining investment. Obviously, the momentum we are seeing in residential investment and also the public space is, I guess, not broad-based across the states. It is most found in Sydney and Melbourne, and to a lesser extent in Brisbane. So those East Coast states are really benefiting, while mining investment deteriorates in WA and also, I guess, to an extent in Queensland as well. The other major release for investment was the Capex Survey. There we saw a 0.1% gain for the key equipment component there, which flows into GDP next week. In addition to that, we had the Capex expectations for both 2015-16 financial year and 2016-17 financial year. We saw in both those outcomes was an expectation of a decline in investment of about 20%, with again mining being the main factor there. With regards to estimate 1 for 2016-17, these first estimates are notoriously volatile and quite often are revised up over time. And we'll be watching as we move through the next couple of quarters as well the weakness we're seeing in services investment expectations, with about a 4% decline expected for that year, start to build and strengthen. Hopefully that is going to be the case as the labour market sees further growth and there's a justification for service firms to start to think about investing more. Offshore, this week we've had the Westpac M&I China Consumer Sentiment Survey. That really highlighted, I guess, the key risks around the Chinese outlook. We continue to see, I guess, we have seen a deterioration in the last couple of months of employment prospects, and that's really continuing to be wedded to what's happening in the export sector. We are seeing quite strong growth in the tertiary or services sector, and part of that's domestic, but it's not really leading to stronger jobs and really into the mindsets of the consumer. And this is kind of a risk in terms of the near-term growth profile, because we need to see consumers continue to spend and to help strengthen that services sector and provide new jobs. And if we don't see that, then we're going to likely see weaker growth. In terms of the other sort of key components of that survey, that weakness in employment did really flow through to family finance expectations, and also people's willingness to actually think about discretionary spending and their perceptions of the housing market. The housing market sort of expectations are quite soft at the moment, and it's really, I guess, probably emphasising that sort of although we have seen a rebound in those key sort of Tier 1 cities, we're yet to really see that pass through into Tier 2 and Tier 3, where a lot of the construction activity actually is, and that's really what's quite key for growth. Next week, the focus for us is going to be back in Australia again, and it's definitely going to be on GDP, which you have on Wednesday. We're expecting a 0.5% outcome for the quarter. Obviously, investments are a drag there. The consumer is seeing relatively moderate growth continuing, but not sort of the robust rate we would like to see. And at the same time, we've got sort of the terms of trade having a material impact on incomes and also on exports. So there's kind of be the key sort of factors we're looking at as we see that GDP outcome. The day before we had the RBA meeting as well, and what's really going to be key there is whether the sort of weaker outcomes we have had around the labour market, I guess, get more mention in terms of the statement. It's potentially going to be the case that they won't necessarily have that in the statement, but more so maybe a discussion in the minutes which are released later in the month. We'll see you next week.